Welcome back to Fast Market here on the Schwab Network. It's time for our cash tag segment. For that, let's bring in our next guest. It's going to be Landon Swan, co-founder of LikeFolio. Welcome back to the show, Landon.
Thanks, guys. Great to be here.
All right. It's good to have you back. Nike, you know what, Landon, this thing has just been struggling. I don't know if it's the executive team. I don't know if it's consumer taste. I don't know if it's competition. What kind of data do you have? Because the bar is really low going on into this report, but maybe the bar should be low because their numbers the past few quarters have not been good at all.
No, the bar should be low. I mean, they've been just not doing well. I mean, the revenue's, down 9%, direct revenue's down 14%, digital's down 21%, wholesale's down 4%. Their margins have dropped a point. They're just, I think it's a lot of bad decisions. And I'm not going to Monday morning quarterback and say that they should have done this or that, because when they talked about going direct to consumer and cutting Foot Locker out of it, I thought, all right, this is a bold move. It's going to pay off. It's going to crush Foot Locker. Nike's going to kill it. That couldn't have been farther from the truth. It was a miss. I mean, if you would have told me a year ago, asked me how is Foot Locker stock versus Nike stock going to do over the next year, I would have guessed Nike up and Foot Locker down, but they're both down about 30% over the last 12 months. And I think a lot of that has to do with, a lot of the decisions that Nike's made. I mean, they've kind of lost their cool. They've been oversupplying the streetwear line. They've forgotten the runners. I mean, if you look at what Hoka and On Cloud have been doing, they've just stepped in where Nike left it wide open for them. Nike has really kind of alienated their partners through that direct-to-consumer push. I mean, what they did was, they focused on capturing existing demand and getting them onto the Nike channel. And they did that through markdowns and discounts as opposed to creating new demand. So really, they just, instead of paying Foot Locker, they just let the consumer pay less, and it didn't work out for either one of them. I think that they realize what they've done, the mistake that they've made with the direct-to-consumer path, and they've got to unalienate their partners. They got to get them back. They got to move, get that shelf space back, move in that direction. And so when we look at kind of the to-do list for Nike, it is they've got to clear a lot of their inventory, which has to be through wholesale discounts. I know that people, investors don't want to hear that, but they've got to do that. They've got to invest in marketing to get their cool back and kind of reorient how their customers see Nike. This is one of the strongest brands that's ever existed, but they've really weakened over the last 2 years or so. And they got to build back those partnerships, like I talked about. That's critical. We've found that. I think they kind of learned the hard way. Again, I would have thought, great move, get all that money to yourself, cut out the middleman, but apparently the middleman's really important. So let's get those back. So there are some bright spots. Their performance gear is doing better than their streetwear. Their basketball shoes, and they're branded. Their partnerships are doing well. Kobe, Sabrina, some others are doing well. So they've got some bright spots, and they have tremendous brand equity. I mean, this is, I think, if you zoom out, it's a hiccup in the brand value of what Nike is, but they're still very strong. It's just going to take them a little bit to get back on the right track. So yes, their stock is down significantly. I think 60% from highs, 30% over the last year. And ever since that June report, their stock went from 95 down to 75. It's just kind of been bouncing around in that gap since then. We're at 72 now. They've been punished for bad decisions, I think, is what happened. But again, I think they can turn it around. I don't think it's on this report. I think it's going to take them a few quarters.
Landon and Tom, for that matter, there's a high bar in earnings, there's a low bar in earnings, and then Nike can't afford a bar. They had to sell the bar. I mean, they literally have no bar to work with. That's how low this bar is for Nike. Now, something good can happen there. Their numbers they're looking for, year-over-year declines in revenue, 11%. Year-over-year declines in operating income, 64%. Earnings per share, 70%. This is a company that I like where you went with your point, Landon, with running. Remember, this company started in the running shoe business, just like On is doing, just like Hoka is doing. They're two major competitors who were nothing years ago, little itty bitty. Now On Holdings is everywhere, and Hoka has got its cult following. and Nike's just the big one. They're still the biggest. They still do the most business, but there's a serious cut into their quality and what they are. So they need to get back into the running business, get through the inventory. That's key here, is to get this inventory out. I think that's the major problem they're having right now, is just inventory they need to empty out the inventory and then just start innovating. Now, I think this Nike veteran, Landon, is a good choice. He's back, hopefully doing the right things. But this is a big earnings event. And you're right, Landon. This stock sold off to $70, $75 and is sitting here lifeless. Your thoughts?
Yeah, it's amazing. Like, this is such a great study in free markets. Like, Nike crushed it with the runners and established this amazing brand through partnerships, Jordan and the like. And now they've kind of moved away from that. They got a little greedy going direct to consumer. They've tried to branch out and do all kinds of different things while forgetting their core. And then, so what happens, right? I mean, OnCloud and Hoka step in and say, all right, we'll take that. And they've just shot up like crazy. I mean, they totally stepped in where Nike stepped out. And you can see it here in the chart. I mean, this is web visits, just basically general interest in the company and their products. Nike's down 15%, OnCloud's up significantly there. So, I mean, it is crazy, the hole that they left and how the free market just fills right in. So it's a study to be looked at. But yeah, they've got a long list of things to do, and this is not a one-quarter turnaround. But you're right, the bar is extremely low. I mean, when you're talking about, the bar is negative 11% revenue. It was negative 9 before. So they're like, we're going to lose a little more than we've been losing, but hopefully that slows down, right? I think it's going to take several quarters. I can't envision a scenario where this stock pops significantly, other than just the bleeding has stopped relief kind of rally, if there's some optimism going forward. But because of everything that they've got to do being a long-term project, clearing inventory takes a while, building back the brand through marketing takes a while, and getting those partnerships, that shelf space, all that stuff takes a while. So I don't think that magically they've done it over the last 3 months. Now, they may say that it's going to take them less time than they thought before, which could be a good sign. But basically, you're just betting on this brand, realizing that they made some mistakes, having a good plan moving forward, and getting there eventually. I don't think that this is an earnings pop kind of play. Now, if they sell off, they get into the 60s, then, maybe you buy some shares and tuck them away and check back in a year. But this is not the quarter that they're going to just pop and have a magical turnaround. It just takes too long to do the things that they know that they need to do.
Yeah, Elliott Hill, the new CEO since October. He's got a big job ahead of him, Landon. But this is all about brand awareness, I think, more than anything, isn't it? Because, we talked about, the direct-to-consumer worked for a while and everybody loved it because the stock was going higher, because the growth rates coming from zero, easy to go higher. That didn't work out, as we found out. But when you look at like a portion of their business, like the Jordan brand, Michael Jordan didn't ruin that brand. Nike's ruining the brand. So is it about a new type of, whether it's a new shoe or a rebrand or a refresh, that's going to take probably a year? Is that the key moving forward, where they get back into it with some type of, innovation in the space?
Yeah, I think so. I think they need quality and innovation, because what they've done is they've sort of traded their brand equity for sales while neglecting quality. And over time, that's going to degrade that brand equity that you have. And meanwhile, people are, they try on OnCloud for the first time and they're like, oh my gosh, these are so comfortable, because they're used to Nikes. And Nike has just been like, you know what, we're cool. We can put out whatever we want. Quality doesn't have to be as high. And eventually somebody steps in and says, you know what, quality is important. And the consumers they raise their hand and they put their wallets out and said, absolutely, we want quality. So I think Nike's got to do they've got a tough job of innovating back to that quality mindset, to where they can build back the trust with the consumers, that when you buy Nike, you're putting on a quality shoe, you're putting on quality apparel. And they lost that. It takes a while to get it back, unfortunately. But again, they have one of the best brands in the world. And so it's a huge asset, and I know they're going to move in the correct direction. It's just a matter of time. So, again, it's not this quarter. They're going to get there, but they definitely made some mistakes. And again, I'm not going to say that at the time I would have done any different, because to me it looked smart, right? But I think, and all investors liked it. And that's why the stock went up so much. But then when the results came in, you're like, ooh, this isn't really working out the way we thought. So time for a direction change. And I think investors just need to be a little patient with this company.
Yep, definitely. We'll watch those results. Bar is low on this one. All right, great stuff as always, Landon. Appreciate it.
Thanks, guys.
All right, that's Landon Swan, co-founder of LikeFolio, breaking down Nike. Kevin, it's just been